Nick Abrahams and Nigel Dobson. Nick Abrahams is a global leader of technology and innovation for Norton Rose Fulbright, and he certainly has innovation chops. Nick has created the world's first AI-enabled privacy chatbot for Parker. He's founded a successful online legal site, LawPath. He's written best-selling books on big data, big responsibilities, and digital disruption in Australia. And last year, Nick won the Financial Times Asia Pacific Legal Innovator of the Year Award. Nick is a much sought-after speaker on future trends and innovation, so we're delighted to welcome him here today. Joining Nick is Nigel Dobson, who is Banking Services Portfolio Lead at ANZ. Nigel is responsible for delivering enterprise platform services that drive ANZ's business outcomes and deliver innovative and customer-focused solutions. As part of his role, Nigel is responsible for ANZ's payment platform strategy, including all payment application services and payments operations for the group. He also leads ANZ's blockchain strategy. Nigel is also chair of Ligon 1B, a digital bank guarantee startup. He's a director of the new payments platform in Australia, a director of the Australian Payments Council, and a fellow of Blockchain Australia. So he really knows what he's on about. Today we're going to spend a bit of time giving you a crash course on DeFi. Then we're going to examine some of the threats and opportunities that DeFi poses to traditional banks, as well as have a quick look at what the future might hold. As a reminder for you, those who are participating via Zoom, you can ask questions during via the Q&A box, and we'll leave time at the end to go through those. So Nick, in the promotional materials, we promised to demystify DeFi, so you could be the man for that. Over to you.
Thank you, Rebecca. Can you just confirm to me, Rebecca, that you can see that on screen?
All good.
All good? Okay, great. So, yeah, I guess, so I'm obviously a partner in a large law firm. I think, Rebecca, the idea of the death of banks would be very bad for our business globally. So can I just say that, people, I had nothing to do with the choice of that title, but I do think it is interesting. I think, you know, financial services is at a massive crossroads, and really, like it or not. And I've been a follower of cryptocurrency for years, and only really recently did I start to believe that there's something real and significant about it. And DeFi was really one of those things for me. And so if you look at the, you know, what's happening with DeFi, we've got, you know, I really see it as, and Nigel has been around this space longer than me and knows far more, but just from my point of view, some of the critical sort of data points for me was in October 2020, we saw PayPal make the announcement that they would start to accept Bitcoin, and that was followed by Visa and Venmo shortly thereafter. You saw the massive Coinbase, which is one of the big crypto exchanges. They IPO'd with $86 billion valuation. And fascinatingly, JP Morgan was one of the co-underwriters on that IPO. And only 3 years earlier, the CEO of JP Morgan had actually said that crypto was shady and not to be trusted. And so it was interesting to see that JP Morgan really found their crypto chops and very interested and obviously did incredibly well out of Coinbase. One thing that I find extraordinary working around the technology space is that there's flaws in every technology. You know, the minute it's deployed, it's found to have bugs. But yet with Bitcoin, which is based on blockchain, it was the first the socialization or popularization of the blockchain technology. Bitcoin, over 10 years, the underlying architecture and the technology has not been found to be flawed. We've had exchanges fall over and so forth. That's not due to a problem with the underlying technology. The underlying technology has found to be incredibly elegant and work very well. So, you know, that to me is quite remarkable. I think one of the things that has kept crypto out of the mainstream is it's just hard to deal with. It's hard to buy. and it's hard to store. You've got to, if you've got any significant amounts of it, you've got to take it offline, store it in cold wallets. Unless you are technology or technically quite skilled, it's quite a difficult asset to manage, and so therefore quite difficult to have it sitting in a self-managed super fund or something like that. So I think the retail side of it has been difficult, and institutionally it's been hard to manage as well, because you are trying to take custody over a piece of code. It's just not something that we've had to manage in the past. But what we've seen now is exchange traded funds. So you've got Grayscale, which is a big fund. So they've got $38 billion valuation. And Morgan Stanley, in fact, started advising its high net worth folks that they should keep up to 2.5% in some form of crypto. Now, obviously, crypto went through this massive crypto winter, as they call it, popped out in spectacular fashion last year, and the numbers on whether it was crypto or Ether or the alternative coins just went stratospheric. And then we saw Elon Musk put a couple of sort of unfortunate tweets out and make some sort of jokes about crypto on Saturday Night Live, and that caused, I mean, that wasn't the sole cause, but it was certainly at the beginning of the cause of a dip in crypto, and yet recently, over the last 2 weeks, we've seen crypto really pop back quite significantly. And interestingly, on the weekend, we saw gold falter, and a lot of people see Bitcoin as gold 2.0. So, the other things on this slide that I think are relevant is, BlackRock, which is the world's largest fund manager. So Larry Fink, I love this. Crypto could be a great asset class. We're watching, we're investing, and we have made money on it. So you're seeing very traditional operators who have stood on the sidelines because crypto has been associated with criminal elements, with ransomware, with drug trafficking and so forth. But now you are starting to see it really enter the mainstream. And we've seen even in Australia, some exchange traded fund applications. We haven't got one yet, but I suspect it will happen in the not too distant future. I mean, one of the problems we've got with crypto is it is heavily manipulated. There's no doubt about that. There's very little free float in it as well, because there's just not terribly much of it around. In terms of just a quick refresh on what is blockchain, because this whole DeFi world really just arises because of blockchain. And so just very quickly, blockchain, just think of it effectively as a massive distributed ledger that exists on tens of thousands or hundreds of thousands of different computers. And the transactions are time-stamped and they are not able to be changed once the transactions have been entered into the ledger. And those computers all have a particular way of validating that a change needs to be made. So it's fascinating technology, and as I said, has proven to be quite robust. The critical players to know about for the purposes of DeFi is obviously Bitcoin. It's the original, more than 50% of the market cap of all coins. Then we've got altcoins. So these are alternative coins, and it's really everything else. And so there's more than 9,000 altcoins, and so some of them are useful, do useful things. Ether, which is the most relevant one for DeFi, is very useful. So it comes from an organization called Ethereum, which is a smart contract framework. But there's a whole range of others that don't do anything particular, and are just sort of speculative plays by people. So you've got Ethereum. Ethereum is a framework which allows smart contracts, and smart contracts are important to understand for DeFi. Smart contracts are not contracts in the sense that you and I would think of them from a legal perspective, but rather smart contract, it's just code, and it's just an if-then statement. It's if the US dollar hits 80, then execute a trade and sell all of Rebecca's Google shares or something like that. It's that all you think about with a smart contract is it's just a piece of code. Don't think of it as a contract the way we would think of them. The other important things to know about is stable coins. So stable coins, they try to resolve one of the critical complaints about crypto, which is the massive volatility in crypto. And so stable coins, they peg the value of the coin to an external reference most usually the US dollar. And so a stable coin, if it's correctly executed, it should just rise and fall with the US dollar. So you take out all of that, the volatility that you experience in Bitcoin and other cryptocurrencies. Just to give you a sense of, so with decentralized finance, what do you care about this? Why is this even relevant? Are we just making this up? So it really rose almost invisibly to the normal finance community, frankly, and it's really risen over the last 12 to 18 months. It's been around in one form or another, but it's really risen into prominence. And to give you a sense of the scale of it, so right at the moment, I just looked on as a site called DeFi Pulse, and what that tells you is the number or the amount of smart contracts that are out right at the moment. And that's the wonderful thing about crypto and blockchain, is that you get amazing visibility of transaction volumes and things like that. Everything is public. And so there's more than $70 billion US of smart contracts out. So that pops around. 2 months ago it was 40 million. A month before that it was 80 billion. So 40 billion. A month before that it was 80 billion. So it does move around a little bit, but it gives you a sense of, within the space of 12 or 18 months, we've gone from nothing to $70 billion of value and people transacting. And as you can see from this slide, there's a lot of players in the DeFi stack. Just a very simple, and I must apologize to Nigel because I will absolutely butcher this in terms of explaining the way crypto works. So Nigel, feel free to come on and put people straight. But if we think about it at its simplest, a DeFi lending transaction is, you may have some Ethereum. So let's say Ethereum is a cryptocurrency, or Ether. So you're sitting on some Ethereum, and what you do is you go to a platform, and so Aave is one of the platforms. This is all online, obviously. You go to Aave and you what's called stake that Ether. So you stake the Ether, and Aave will then give you a stable coin. Stable coins in response to but basically because you've given them the Ether, they then give you on a 5-to-1 basis, as in, so you would get 20% of the Ether that you stake. They will give you a stable coin, and with that stable coin, you can choose to do with that whatever you like. You could buy more crypto with that. You could potentially buy something online if you can find a place that will accept crypto. You can convert it into fiat currency if you would like. And then what happens is, at the end of the agreed period, or at some stage earlier if you like, you go back to Aave and you effectively give them back the same amount of tether that you took. So this stable coin, it's called tether. So you give them that amount of tether back. You pay them an interest rate, could be 6% or something like that, and then they will return you the amount of Ether that you had. So it's called a staking transaction. It forms the basis of a lot of DeFi transactions. It's similar in some respects to traditional banking and finance style lending transactions. And what's relevant about this is, I think it really arose, and Nigel may have a view on this, but we've seen a lot of people get a lot of wealth out of cryptocurrency. Those who are early believers, when you're seeing something grow at 100x or 1000x. So there are a lot of people sitting on a lot of crypto, but they have this great belief that they don't want to swap into fiat currency. And that might be driven because they love crypto, or because they don't like tax, for a whole range of other reasons, but they don't want to get out of the crypto sphere. So what this does is it allows them to actually get some temporary liquidity, take the volatility out because you've got a stable coin in Tether, and then you can come back and grab your Ether later on. So yeah, I've pretty much covered that. Let's get into then there's an insurance. This is very new area, but there's concepts around insurance. So what we know about crypto is that it's dangerous. This is obviously not financial advice that you're getting here. This is not a world for the faint-hearted. And so how do you know that, for example, in that last description, we were using a platform called Aave. How do you know that Aave isn't just going to up stumps and take your Ether? and you'll never get that back. And so what you can do off the back of an Aave transaction, for example, is you could insure that transaction through, for example, there's another platform called Nexus Mutual. And so they will basically bring underwriters together in a decentralized fashion. So you'll have underwriters who all come in agreeing that they want to underwrite a particular style of transaction. And then you, as if you're doing the staking transaction with Aave, you could take out an insurance against Aave going belly up as a result. And so let's say Aave did fail and you lost your ether, you would then call on your Nexus Mutual insurance to get them to replace your ether. And this is all done by smart contracts. So this is all code. So and that's, as I said, that is the genius of DeFi, is that this just operates without human intervention. It's 24/7, 365 days of the year. You can do this. Then just also we're starting to see decentralized exchanges. So what we do have right at the moment is we've got centralized exchanges. So Coinbase, I mentioned before, is one of those. Kraken, there's a whole range of different exchanges which you can buy and sell crypto on. And they operate very, very similar to a normal sort of, the ASX, for example. So that's a traditional exchange model. What we're seeing now is decentralized exchanges. And so basically Uniswap is an example of that. So it's just a platform, and what it does is it brings buyers and sellers together. But it's peer-to-peer in terms of the way the exchange actually works. So yeah, I think it's what's interesting about a decentralized exchange is that as I said, there's no intermediary, but also the interesting part about crypto is that you can go through decentralized exchange. You can go direct from ether into Bitcoin or into other cryptos without having to go to cash first. So you can go direct. One of the problems with the Ethereum network right at the moment is that it is struggling to process all of the smart contracts, and there's a concept called gas, which is a fee you have to pay to process a transaction, which I won't go into in any detail. I did want to talk about this just quickly because I know it's a bunch of lawyers on the line, and I just think this is fascinating from a legal point of view. This is non-fungible tokens, slightly outside of DeFi, but Rebecca, just one moment on this, if you will. We're seeing a lot of this right at the moment. So we saw this, if we think about what the internet has done, is it's made it incredibly easy to copy things, particularly, for example, digital artwork, and you can copy it flawlessly an infinite number of times at zero incremental cost. What non-fungible tokens give us the ability to do is determine who is the rightful owner of the original, in this case, artwork. And so we've seen some extraordinary prices being paid for what's called NFT. So $69 million US for a piece of digital art by an artist called Beeple. There's virtual sneakers that you can have online and you could wear in your virtual world. So Roblox, and there's a few other virtual worlds. And I know there'll be people who'll be going, that's Nick carrying on like a crazy person again. But these virtual worlds are really quite significant. You can now, through NFTs, you can buy real estate in virtual worlds and sell it, and people are making quite a lot of money. And there's a business called Zed.Run, Zed.Run, and that is NFT horse racing. And it's Australian creative, wonderful business. They've gone incredibly well. And I was explaining it to a friend of mine the other day, and we were all a bit like, NFT horse racing, whatever. She explained it to her 14-year-old son. And in 2 weeks, that 14-year-old is up $4,000 as a result of NFT horse racing. So there's a whole range of things that are wrong with that in terms of, underage gambling and so forth. But this virtual world, the so-called metaverse, is coming very quickly. Just on this one, there's so you remember player cards and so forth that we used to have trading cards. That's now gone completely online with NFTs. So the NBA has all of their players available as NFTs, and then Jack Dorsey, the Twitter CEO and founder, sold his first tweet for $2.9 million as an NFT. That's the ecosystem. We don't need to talk about those. Just, I guess, just the final comment from me is I do always warn people after they've heard a session like this is don't go out and buy this stuff unless you've really read up. This is incredibly volatile. So this is, as I said, it's not intended as financial advice. So there's some sites. There's a million sites out there that you can look at, but here are some of the ones that I look at. And so, Rebecca, that is me. Thank you.
Thank you very much for that, Nick. That is illuminating. I'm especially impressed that there is NFT horse racing that is, I don't know, sort of mystified and made my day in equal measure. Nigel, there seems to be a lot in that. I mean, one thing that I noticed straight away was 6% interest. Which bank wouldn't love that, right? So, I mean, how do banks sort of compete with a lot of the technology, and you know, what are the threats and challenges for banks coming out of DeFi?
Well, I think that, you know, the DeFi world, as Nick described it very well, represents the community of digital asset owners today who, for whatever reason, and I think he's also correct to assert that many of them probably don't like paying tax because they've got huge unrealized gains in their asset portfolios over the past several years in particular. And I think that the DeFi marketplaces have evolved because holders of these digital assets want to get more from them, or they want to invest in new digital assets as they come online, but without converting back into fiat and dealing with the consequences thereof. So I think these marketplaces provide perfect venues, not only to bring borrowers and lenders together, and it's very much the analogy of peer-to-peer lending. So if you understand peer-to-peer lending, this is really peer-to-peer lending in a digital asset world. Same concept. It's driven more by algorithmic outcomes and controls. But there's also stakeholder voting in terms of how the platform evolves. So the stakeholders in the platform will be the lenders in particular, and to an extent the borrowers. And they together as a community can decide the direction, the rules, and the development of that platform. And I think that the developments that I'm seeing, so for example, I saw the Aave protocol mentioned earlier, you know, that's developing continually, and it's converging more and more with what we would define as traditional finance. They're writing new protocols for stable interest rates, for term deposits and term lending rather than perpetual, which is what the current arrangements are. So the more I understand these emerging protocols, the more they resemble traditional finance, because humans are still humans and economics still works in the world of digital assets. And so interest rates, to your question, Beck, why do you get an interest rate? Well, because, you know, people stake or deposit large amounts, or they over collateralize in order a crypto deposit in order to borrow another token. And the Aave protocol, for example, gives you A tokens or Aave tokens, and you can then buy other cryptos that you think are going to appreciate in value, or whatever you choose to do with it, and you pay back as is deemed reasonable. You will be charged an interest rate, just like a traditional peer-to-peer market, and the lenders in that market will accrue or can stream actually interest tokens, again in this A token protocol. So if I just zero right back out of that and say, well, why does this even exist? It is for the benefit of you know, digital asset owners. But then if I think about tokenization as a trend, you know, I liken this to the emergence of TCP/IP protocols back in 1995, the emergence of the internet, the digitized world that we all live in today is something that we find, you know, commonplace. It's just on, and we're communicating across it right now. But 25 years ago, this was a new frontier as well, much in the same way that tokenized protocols are representing a new frontier. And oftentimes when you do get these huge pivotal trends, changes in protocols or business models, you do get this kind of, I don't believe it could possibly be true moments, and you get the resistance and you get the regulatory oversight and attention, which is warranted. But then ultimately you get acceptance, right? And you get vast, acceleration in new business models, and often, economic growth as a result. So I take the view that tokenization protocols are here to stay and here to grow, and that they will be similar to that wave of digitization that we saw in the late 90s. And of course, the adoption of these protocols by, amongst others, banks, right? So initial reaction to the internet was, I couldn't possibly do a transaction on the internet. And now it's, why can't I do a transaction on the internet, right? So to the extent that tokenized protocols offer better, different, arguably faster and cheaper outcomes for financial services, then I think banks will adopt these protocols going forward.
Fantastic. And so I guess with banks adopting the protocols going forward, what does that mean for banks? What are the opportunities for banks? How does that play out?
Well, I think what we have to understand is what are the advantages of a tokenized coin or cash or even tokenized assets, as Nick described around NFTs. NFTs enable digital creators to sign their artwork or their creations and then own them. So digital rights have been very, very difficult historically to assign and to defend. Now with tokenization, you can legitimately defend the ownership of a digital creation. And I think that's really important. It's essentially the same as an artist signing a canvas, but it's in the digital world. And by the way, you can tokenize physical assets like a picture as well, should you choose to. But in the world of tokenized assets, that gives tremendous rights and economic value to digital creators. I think it also gives you clarity, increasing clarity on the legal framework, albeit emerging, around this ownership and around the rights of owners. It also gives owners the ability to fractionalize their assets. So you could sell, a 100th or 100,000th of your digital creation, be that a photo, a song, or whatever it is, could be a video. And marketplaces for fractionalized asset sales and purchases is what we're seeing growing tremendously. Now, Nick mentioned the digital horse racing. That's an example where, somebody's son could own, a small percentage, arguably, of a racehorse, albeit that this racehorse is a digital creation. But this idea that you can fractionalize digital assets down to very, very small, affordable slices of digital asset, which can be bought with arguably digital coins or even fiat, but predominantly digital coins, opens up a whole new range of financial services that probably were not accessible. And when you think about, if you wrap that up and say, well, securitization as we understand it today allows huge parcels of assets to be linked together and sold off in packages, parcels, and somewhat fractionalized between the institutional buyers, the professional investors who buy securitized assets, REITs, for example, that they are effectively fractionalized, but only to a point. But if you think about extreme fractionalization, then anything that you can securitize today, both in the physical and digital world, could be made accessible to retail investors, to our children, arguably, should they be safe doing so. But the idea that there's no threshold barrier to investment, I think, is really, really important. And then if you think about the other side of the coin, which is as you can fractionalize down to almost billionths of an asset, well, what does that mean? It means you could buy a billionth of an asset, which means, well, I can actually make a micropayment, right? So the other side of that coin is, well, no pun intended, but the other side of that is that you can make a very, very small payment. And so a token that could, and there's I think, Nick, you had it on one of your slides, there was a Drop is a recently launched micropayment site, which is associated with media. And for me, it breaks a hole right through the subscription model and the streaming model that we have today. So, for example, if I can make a micropayment to a media website, and it doesn't matter where it is in the world, and that's the important piece, and I can stream a movie in real time based on a micropayment that I've made, or micropayments that I might make through the streaming of that content, then that changes the world completely. Subscription dies and user pays grows, right, over time. And why can't you do it today? Because micropayments aren't economical. You cannot put a 10-cent payment on Visa and have that be economical for the merchant and for the bank that issues the card. But in a world of tokenized assets with tokenized coins that can be fractionalized down to a 10-cent payment over a network, which is open 24/7, operates in often very, very fast paced, very high transaction throughputs compared to Nick's original example around Bitcoin, which is very slow. But crypto 2.0, 3.0, they are as fast as the Visa MasterCard network, and they settle pretty much in real time. You can envisage a world where that streaming content is paid for by paid per view or paid during view over a micropayment application.
I guess going back to your observation about securitization, one area where it seems that this might also open up would be for syndicated lending, in terms of even being able to fractionalize debt down to very small amounts might even facilitate mum and dad investors. A nightmare for agents who are trying to collect consents and things like that. But that really does seem to potentially be a shake-up there. What are your thoughts on that?
Well, I think it does, and it's just another example of this, this fractionalization over a secure token-based network. And I think the important piece is to frame it in that way, right? There is no agent anymore in this securitization, right? So, this hypothetical securitization. The role of the agent is overtaken by the network and the algorithms that drive it, the smart contracts that are largely, as Nick explained, self-executing protocols that will distribute interest. They'll distribute ultimately the principal back to the lenders upon receipt of redemption. All these things, but you're right, they can be brought down into the mum and pop or certainly the professional investor sphere, subject to, I would imagine, suitability and appropriateness regulation that has to sit around that, which we have today. So there will be guidance around what assets can and should be tokenized, fractionalized, and the syndicating or the securitization processes. But it's all doable, right? And there is a legal framework around that today. It just doesn't recognize the participants as being individuals rather than professional investors.
Yeah. I think that the idea of no agent is fascinating in many ways. I think particularly because a lot of our agent colleagues seem to spend a lot of time looking at things like consents and waivers. So I think that, Nick, you might have views on this about how smart contracts can deal with things when it possibly goes beyond your binary if-then outcomes.
Yeah, I think, I'm not sure about that. So when smart contracts originally came out, I approached it as a typical lawyer, thinking, "Oh dear me, how could computers possibly do what we do? I know what it takes to put into a contract, and they're very long and important and so forth." And so I think there's a real limitation on what smart contracts can do. And in fact, I think we do ourselves a little bit of a disservice by calling them smart contracts. I think it creates an unrealistic expectation, at least from what I've seen so far. So right now it's sort of programming that will get you to a certain outcome. But I think once we start, if there's any aspects of discretion or interpretation, then I think this smart contract idea falls away. It's really, and Nigel, you spent far more time around this particularly from a technical point of view. I would really welcome your thought, but I think it's you can only rely on the machine to take you so far, and I think the more that if it can all be programmed, if you can do a decision tree in relation to it, and if then I think you can probably get there. But sometimes these things are difficult. One of the learnings I think from LawPath, the separate business that I have, and we've had over 200,000 users of that site, and with a whole range of different legal questions, it's awfully hard to automate what we do as lawyers. Now, I'm not saying it can't happen. Obviously, anything can happen, but because of the fact that, you know, in almost every situation, it's a bit bespoke, and how do you manage through that? So I feel like, at least right at the moment, there's a real limit on how far the technology can take us. But Nigel, I'm interested in your views on that.
Yeah, look, I would agree with that, Nick. And frankly, you know, for most enthusiasts, there's a certain place beyond which you don't want the technology to take you, and human intervention is actually warranted and valid. And that in particular goes to stakeholder problem solving, stakeholder development. So DeFi is built around venues where stakeholders do make governance decisions around the platform. And I think that's the valid answer to the question, is that yes, we'll let the algorithms do what they can do. We'll let them advance the sophistication of our platform, but we will not let them make the decisions for the future of the platform. And I think that's where the human element comes in. And that human element has to respond to increasing levels of regulation and scrutiny. It has to respond to competitive threats from other DeFi platforms. And so, you know, judging, having oracles that can read the market rates on other platforms and the experience on other platforms is important. And then also just saying, well, who are we as a platform? What do we want to be? And that's a human decision ultimately, because the interaction is still based on human decisioning, even though the execution of the contracts is increasingly and desirably automated through the DeFi marketplace.
So I guess then, Nick and Nigel, where to from here for banks? You know, you were saying earlier, Nigel, that you sort of saw that DeFi platforms were sort of becoming a bit more like mainstream banks, and possibly at the other end, mainstream banks adopting a bit more of a DeFi approach. So, you know, putting on your, you know, talking about Oracle before, was putting on your visionary glasses for where to from here. What does the future of banking look like in terms of
I'm wearing those right
DeFi?
now. Yes, so
yeah.
Look, I think I made the comment deliberately around this sort of what I see as a convergence of the DeFi world in the land of crypto, resembling very increasingly peer-to-peer. Now, peer-to-peer lending, as we understand it today, has been around since 2012. Hasn't actually grown in the way or to the scale that many people predicted at the time. And there'd be a bunch of reasons why that's true, but we're not going to go into that. Rather, it's that it may well become that far removed, which is not very far away from traditional finance, right? What banks can bring to the table is obviously their curiosity, their resources, over 200 years in our case, or almost 200 years of experience in risk management and regulatory oversight and understanding of the economics of transactions and marketplaces. I think that, you know, if we see that there are genuine benefits in dealing with tokenized and digitized assets in the future, which at this stage we do, quite convincingly, then it's about, well, how do we navigate a world where we can remain compliant, we can remain supportive of our customers' endeavors, and obviously very aligned with all of the regulatory controls that we have to observe today. And I would say that, you know, when it comes to digital currency, for example, there are not many things that we would have to do additionally than we do today around you know, anti-money laundering, counter-terrorism, reporting obligations, suspicious transactions. All of that regulatory framework would move precisely along the same path that a digital token would move, and we're looking into that right now. So we're in conversations with a number of parties that are looking at central bank digital currency, stable coins that are fiat backed and are fully collateralized by cash. And if you think about what that stable coin might look like, imagine a stored value card today. We've got those, they're regulated, you accept them from David Jones and you go and buy something. A stored value card is effectively a digital token in a plastic form, right? So if you think about a stable coin as a digital form of that stored value card, you are transferring value from party A to party B. There may be some programmability involved in that. So a stored value card, you can only redeem it at Myers, right? Or David Jones, for example. Now that's programmed to give that value based on a set of criteria or parameters. You can do that with tokens. You can program tokens to be redeemable at certain venues for certain purposes, and then all the other benefits around fractionalization, speed, low cost, etc. So we think, the frontier of this world starts with digital currency, and we're very engaged in that space today. We're collaborating with a number of other banks, and recently there was a digital finance cooperative research center set up, or it's about to be set up and federally funded. So there's a $60 million grant being given to the Digital Finance Cooperative Research Center. And we spoke to them yesterday. There's some very promising use cases and supporting academia as well as the commercialization of some of these decentralized finance ideas in mainstream finance. So I think we've already crossed the threshold of accepting that this is just a new way of delivering financial services. What we're waiting for is the marriage of customer need, regulatory oversight, and some sort of scaled production of the services that are yet to be built.
Thanks, Nigel. Nick?
Yeah, I think Nigel has put it very well. I think the opportunities are extraordinary, for efficiencies and so forth. I think to take the analogy that Nigel has given us, which is back at the beginning of the internet, and no one wanted to transact online, and you look at the efficiencies for the banks that have been received out of online transacting, and frankly the wonderful customer experience that we get. So I think the opportunities are extraordinary. Maybe just for the sake of looking at the counterfactual, one of the challenges, I think, for regulators is, how do you regulate if you lose control of your fiat currency? So if no one has to off-ramp into fiat ever, then how can you, there will be those organizations that obviously, exist as bricks and mortar in some way, and so they will accept jurisdiction and so forth. But I feel that we're moving into a world that, as it says, decentralized. And even, it's fascinating with a number of these DeFi players, you can't even figure out who's behind them. There's one quite significant one out of Australia, and all of the founders and promoters are anonymous, effectively. So no one's. So it's and then we've got the concept of the DAO, the decentralized autonomous organization, which is an organization which would exist differently to a proprietary limited structure, but rather exist in the same way as a blockchain solution does. So there's a consensus mechanism built in to the DAO. So I think we are at a point where we are starting to challenge a whole lot of things that we've really thought of as being pretty set for the last little while. And so it'll be interesting to see how it plays out. I think that there will be an element that just stays in this decentralized world, and be very difficult for regulators to actually get their hands on them. But I think, to reiterate Nigel's point, I think the opportunities and the opportunity for wonderful customer experience and so forth will certainly be extraordinary. So yeah, I see it as overall it's a great opportunity for banks.
I'd like to pick up on that point you made, around the sovereignty, the monetary policy angle, right? Because that's another piece. We probably haven't touched on that, but it's important to recognize that the crypto space represents private money. It's not issued by any central bank, either controlled by, monitored by, and monetary policy has no impact on that whatsoever. And this trillions of dollars that's moved into private money over the last 5 years, I think has put a lot of the central banks on high alert. And it's probably the first time in my 30 plus years of banking that I've seen central banks leading technology innovation in the way they have today around central bank digital currencies, right? So the CBDC development has been almost across the board globally. Now, why is that? What's motivating them? It is precisely this threat that public money will move to private money venues, be unregulated, be outside of the scope of monetary control and authority. And so if you can create a central bank digital currency, or even a compliant digital token that is issued by commercial banks, that's much more preferable to a central monetary authority who want to retain that control. And you can still have the same utility. You won't get the same speculative value that you might from, you know, an unstable coin or a crypto coin, but you will get the same utility that many of those cryptos promise around speed and fractionalization, programmability, etc. So that to me seems to be the frontier that's relatively narrow, but it's the path that we as a bank are traveling down right now, because we know that we can guarantee the compliance with regulations, the stability that many of our customers will arguably demand, but also all of the attributes that tokenized currency has.
Yeah, it's a great point. I think one of the other things to note on that front is, and this is just an observation, that I think what we've seen is almost those central banks. It's almost been the smaller countries that sort of don't necessarily have, you know, so much at stake, if you like. And we did, I think it's the world's first sovereign cryptocurrency. So the sand dollar for the Bahamas. So we acted for the government of the Bahamas on that. And it was interesting to see, you know, who would have thought that the Bahamas would be leading the world on sovereign crypto. But I think, you know, there's an opportunity, I think, that smart countries have seen to say we can take a leadership role here, and if we can get the regulatory settings right, then there's an advantage, and that's, I think, sets, you know, it's a great opportunity, I guess, for Australia. We obviously got you know, Senator Bragg and the work that's being done there, and it'd be good to see if Australia can get some regulatory settings. It's a much bigger discussion, of course, but you know, it'd be good to see us you know, take a leadership role in that, I think.
Yeah, look, and I think there's plenty of evidence that is in fact the case. You know, there, as I said, that, you know, digital finance CRC is a really good example of that. That's a 10-year project, by the way. And so we're really excited by that. I think your point around developing countries is also really valid, Nick, because there has been, I think, Laos, Cambodia, Bahamas, a lot of these countries are kind of doing this leapfrog. You know, we first saw this. If you go all the way back to Kenya and Tanzania with M-Pesa,
right,
which is effectively phone credits, right? So phone credit as a form of currency, it evolved and was dramatically successful. This is more than 10 years ago too, by the way. That was really the first kind of, you know, non-monetary based digital currency, if you like. And that showed the world that developing countries had a need to service the unbanked, and because there were frankly more mobile phones than there were bank accounts. And you know, that's just the reality that we're dealing with. So from a developing country point of view, they're highly motivated to move to a digital currency type world, and leapfrogging effectively many of those kind of old tech or paper-based technologies that would just be unworkable. So those are the countries where the benefits are probably seen to be greater. I frankly still have many conversations with our friends at the RBA, and they're still not really sure about what the use case is in an advanced economy like Australia, which has extremely good access to payments, electronic payments, etc., real time. And they're sort of scratching their heads a little bit at why would you do this? For me, the bigger game is about the tokenization of our asset portfolios. The currency is just the oil that greases the wheel for digital assets and digital asset exchanges. And so if we think about it that way, I can get there very quickly about, you know, having high conviction that digital currencies are the underpinning of digital finance.
That seems like it could be a great opportunity for us to have a look at Q&A. There's certainly been a lot of chat going on in the sidebar.
Yes, I've seen
but in terms of the one question we have is whether there is a fundamental incompatibility between DeFi based on public blockchain that transcends national boundaries and the traditional regulation of financial services lending on a national basis, and whether there's a role for IOSCO, etc. there.
Well, I think that I'd be very interested in Nick's answers, but since I'm off mute, this is the question that's really interesting. What is the regulatory perimeter around which you put these marketplaces? Obviously, it's easy with a national regulatory framework to manage peer-to-peer lending in Australia, for example, or even digital finance in Australia. But these are inherently global, jurisdiction-less networks that have grown up on that basis. Not only that, but I mentioned 24/7 before. that is critically important. All of these networks are born 24/7, 365. That's profoundly different than today's financial services architecture, right? And that alone is enough to transcend today's operating environment to give people access all day, every day. There are no cutoffs. There's just a continual marketplace that never stops. That is so different from what we experience today in financial markets. You know, today we talk about T+1, T+2, end of day business, batch run in the evening, overnight. That's all gone. That is completely wiped off the table with these new emerging born native, token native, often cloud native, in fact, probably exclusively cloud native, but also 24/7. That's a really, really interesting mix of attributes which the traditional financial services architecture cannot compete with in the medium term.
Yeah, that's right. It is funny, isn't it? Just when you mentioned, T+2, T+3, we've become so used to that. You just think of the opportunities of real time, which I know we're headed to in Australia, obviously. So I think, Rebecca, to that point specifically that was raised, the big issue around regulation is nexus, and what we find, and we've been struggling with this in the internet for a little bit, which is, well, who's got the jurisdiction? We've seen the tax debate around the big hyperscalers, and they obviously generate a lot of revenue out of for example Australia, but don't necessarily pay tax in Australia. So there's been quite a profound debate about that globally. I think you take that one step beyond with DeFi though and crypto, because you don't have traditional capital markets where those big hyperscale providers, be it Amazon or Google or whoever, they are all listed on, they might be listed on the New York Stock Exchange or whatever. So there's a nexus there, so you can regulate them because that they've had to access capital through a regulated capital market. So that's how you drive the regulation. We saw it with the initial coin offering boom of 2 years ago, which these folks aren't going to traditional capital markets to get funding. They're getting funding in crypto, so it's native crypto funding, and there's no sort of centralized point where you could say, okay, well, they are clearly regulated by the US rules because they're listed on the New York Stock Exchange. So I think you probably see this world where you've got a lot of organizations that are really difficult to regulate because they just don't have a home anywhere. So I think the geography issue is going to be significant.
Thank you. Nick, certainly it seems that from the chat, of which there has been an enormous amount, so thank you everyone for participating. One thing that really kind of does seem to stand out is in relation to the smart contracts issue and around how easily that could be manipulated with hacking and issues like that. And to a degree, I guess that goes back to the point made earlier that there, ideally you will still have a layer of human discretion over the top. So what is self-executing is going to be limited. But just, do you have any observations on that?
Yeah, and Nigel, I'm sure, will have a view on this. So if we start from the proposition that technology can be hacked, obviously we recognize that. I think, and there's a few people saying, question about how legit my comments were around blockchain or Bitcoin still having stood up. I do think that it has stood the test of time. I think that's because it's the consensus mechanism, that architecture has proven itself to be very robust, would be my argument. I know some people saying Ethereum's had some hacks with the contract structure. So I think that's right. In fact, we saw a big attack on an Ethereum-based product, and it caused then the consensus group to come together to actually try to agree on a fork to rectify what was clearly a wrong. Very fascinating situation. This is entirely outside of legal stuff. I don't think anyone was getting any legal advice. This was a technical fix to what had been a flaw in the contracting framework. So I think those smart contracts, they will have flaws in them, and not to say, the underlying technology, whether it's Ethereum or whatever else, the flaw doesn't necessarily have to rely in there. It could be in the coding of the contract, which is sitting on top of that. And so, yeah, there will be problems with that, and that will need to be reconciled. So I don't for a moment suggest that smart contracts are, will be incapable of being hacked. I think, there will be challenges. But I think what will be interesting is if we look back as short as 5 years' time, if we're 5 years into the future and we look back at this, I think we will say, oh, well, DeFi, well, of course, it's a part of what we do. And, it's a very, very clear, I think, but the road from now to 5 years is not going to be a linear progression. We are going to have, some horrible technology failures, I'm sure some horrible hacks and scandals. But I think the momentum appears to be headed in the direction that smart contracts, cryptocurrency, tokenized assets is something which will be a part of our environment in 5 years' time. But Nigel, I'm interested in your views on that.
Well, I think that the culture of development of these networks is profoundly different than the vendor-based model that we have today, right? I mean, vendors keep their code secret, whereas these communities share the code, they stress the code, they develop it together, and they solve problems together, and they have a governance mechanism often around that. So it's a very different paradigm to finding out you've got a problem when someone's hacked you because no one's ever exposed the code to community review. And I think that's one of the great powers of these types of decentralized protocols is that they are transparent, that they're not trying to necessarily sell the code, right? So they're open to critique and to feedback and to change. And that is, I think, the appropriate paradigm for this kind of network where you can solve problems very quickly. Not to say you won't have them, but the community's interest is wildly in favor of successful outcomes and fast resolution of problems rather than trying to defend their product, for example, or to try and keep it secure and secret. It's the exact opposite. And I think that transparency and openness and the culture of that development community lends itself to a much more robust and resilient system. That's in addition to its inherent decentralization. But from a code point of view, I do think it's actually a much better paradigm in which to operate.
Well, on that upbeat note, we might call it to a close. Thank you both so much for your insights today. It's been super informative, and I think it's really given people a lot to think about. As an employee of a bank, I'm relieved to know that there does still seem to be a future for banks out there. So thank you for that. It's not the end as we may have predicted. I'd also like to quickly thank all of our sponsors. The BFSLA is a not-for-profit organisation run by volunteers. And so our sponsors do really help us to be able to put on fantastic webinars that are free, like this one today. And also, and here's a blatant plug, our annual conference, which is being held on the 27th of August. That will be virtual in Australia, in person in Auckland, which is fantastic and very jealous making. If you're outside of Auckland, you can participate virtually as well. Please go to our website to have a look at the fantastic lineup of speakers and presenters that we have, and you can register online there as well. So once again, thank you all very much for attending today, for your enthusiastic participation via chat, and importantly to our speakers for their valuable insights. Thank you so much.